Hello everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. What we have got here today is a practice question for the topic correction of errors. In this question, you will learn to identify the different types of errors that are involved and also prepare the relevant journal entries to correct these errors. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain to you and go through it step by step. With that being said, let's begin. In 31 December 2017, the accountant of Rain Umbrella Limited discovered that there were several errors in the business books. So we have identified four types of errors here. So let's look into the first error we have made. Purchase of furniture costing $5,000 was recorded as repairs. So what happened here is that we bought a non-current asset, but we ended up recording it as an expense. Assets and expenses are different categories to each other, okay? So when you have an error where you have misplaced your categories, which in this case is recording an asset as an expense, those types of errors are what we classify as an error of principle. The key word here is principle. This is because the error is within the fundamentals. That is the fact that we wrongly treated the purchase of a non-current asset as an expense. Okay? So as you understand, error of principle happens when you have the wrong categories involved. Okay? Now, how do we correct this? Originally, we increased our expenses by debiting the repairs expense by $5,000. Okay, but we know that now we have to reduce that repairs expense amount. We know when expenses go up in value, we debit them, but now that we have to reduce our expense, we have to credit it. So we are crediting the repairs expense by $5,000 as a correcting entry and simultaneously increasing our total assets, specifically the asset account for furniture. And when assets increase, we debit them. So we are debiting furniture by $5,000. Okay? So the correction in this case is to debit the furniture account by $5,000 and to credit the repairs expense account by $5,000. When we are debiting the furniture account by $5,000, our assets are increasing by $5,000. When we are crediting the repairs expense by $5,000, our expenses are decreasing by $5,000. Okay? Now, how is the profit affected? So we understand that our expenses are going down by $5,000 and profit has an inverse relationship with expenses. Therefore, profit should go up by $5,000. And this is also validated by the fact that profit is calculated as the difference between revenues earned and expenses incurred, which is the fundamental basis of preparing the income statement or the statement of financial performance. Okay? All right. Now, let's look into the second error which we have made. Payment of $460 to trade payable Sam was recorded as trade payable Sammy. All right. So as you can understand, the category here is trade payable, or the credit suppliers of the business. Okay. So within this same category, we can have different suppliers. So a transaction that happened with one supplier was wrongly recorded in the account of another supplier. Such events are what we classify as an error of commission, where we have got the same category, which in this case is the trade payables, but the wrong account has been used, where you recorded the transaction in the account of Sammy, instead recording the transaction in the account of Sam. Okay? All right. So I need you to understand the original error that we have done when preparing the journal. All right. So the error that we have made when preparing the journal was to debit the trade payable account for Sammy by $460, which is the fact that liabilities have gone down, and when liabilities go down, we debit them. While the correct entry for the cash at bank being credited by $460 is okay, because when you have made a payment to any trade payable, your funds available in the bank account would decrease, and bank account being an asset account, when it decreases would be credited. Okay? So the main error here, as we understand, is the account for Sammy, which we debited by $460. Now, how do we correct this? To correct this, we have to increase our balance that we owe to Sammy. Now that we have to increase the balance that we owe to Sammy, Sammy is a trade payable, which we understand, which means that Sammy is a credit supplier, which means by default, Sammy is our liability. Now that we have to increase this, we have to increase our liabilities, and when liabilities increase, we have to credit it. So that's why we're crediting the account for Sammy by 460. Okay. At the same time, we know that we made the payment to Sam, right? So originally, we know we made the payment to Sam. Therefore, now we can reduce the balance that we owe to Sam, therefore decrease the liability that we have with Sam. And when liabilities go down, we debit them. So therefore, we can debit the trade payable account for Sam by 460. Okay? All right. So the correcting entry here is to debit the trade payable account for Sam by 460 and to credit the trade payable account for Sammy by 460. What's the effect on profit? It is zero. And why is that so? If you look at the journal entry which we have done for the correction, when we debit the trade payable account for Sam, we are actually decreasing our liabilities. And when we are crediting the trade payable account for Sammy, we are increasing our liabilities. Profit is calculated as the difference between revenues earned and expenses incurred, right? Therefore, we do not really have any effect in this case because only liabilities are involved, all right? So therefore, the effect in this case is zero. All right. Now, let's move to the third error which we have got, okay? Payment of $560 to insurance by check was recorded as $650. All right. So let's look into the original error that was made. So we ended up debiting the insurance account, which is an expense account, and when expenses increase, we debit them. So we ended up debiting the insurance expense account by $650 and crediting the cash at bank account by $650. Okay. But the original balance was 560, and as you can see, some misplacement with numbers are involved in this case, where 560 has been wrongly recorded as 650. This means that we have overstated our expenses by $90. And how do I know it's $90? Which is simply the difference between 650 and 560. And at the same time, we have also reduced our funds available in the cash at bank account by $90. Okay. Now, what's the correcting entry in this case? What we have to do is reduce our insurance expense account. And when expenses go down, we credit them. So reduce the insurance expense account by $90. And at the same time, increase the balance available in our cash at bank account, which is an asset account, by $90. We are debiting cash at bank account by $90 because when assets increase, we debit them. So we debit the cash at bank account by $90, and at the same time, we credit the insurance expense account by $90. So based on this correcting entry, what we understand is that we have increased our assets by $90 and decreased our expenses by $90 because originally we misplaced the numbers by recording $90 more. Okay. So what's the effect on profit in this case? So we clearly understand that expenses are being reduced by $90, which means profit should go up by $90 due to the fact that profit and expenses have an inverse relationship, and profit is calculated as the difference between revenues earned and expenses incurred. Okay? All right. Now let's look into the last error that we have got, which I believe is pretty straightforward. Drawings of $250 for goods taken by the owner was not recorded. So not recorded at all. And this is clearly a case of an error of omission. Okay. So we have got an error of omission here where the transaction was completely forgotten to be recorded. And now we have to record it. Because the owner has taken goods, which are referring to the inventory. And inventory, being a current asset, is now going down in value due to this withdrawal. We have to credit the inventory account by 250, mainly because inventory is a current asset, and when assets go down, we credit them. At the same time, we know we've got some drawings. So simultaneously, we'll be debiting the drawings account by 250. And we are debiting the drawings account by 250 because this is referring to a reduction in the owner's equity or capital available for investment within the business. We know that capital by default is credit, which means when capital increases, we credit them. But whenever there are drawings, which is essentially a reduction in the owner's capital or equity available for investment in the business, then we have to do the opposite of credit, which is to debit. So the correct entry, which is to what we will be recording in the books, is to debit the drawings account by 250 and to credit the inventory account by 250. And when we do that, we understand that our capital available for investment in the business is going down, and at the same time, our current assets are going down by $250. Again, in this case, we have no effect on profit because, as you understand, we have the owner's capital and the asset accounts involved. Okay? And profit, as we know, is calculated as the difference between revenues earned and expenses incurred. Okay. Now, the last part is to prepare a statement to show the correct profit for the year ended 31 December 2017, which is pretty straightforward, in my opinion. So if we read the question again, we know that we were given an unadjusted profit prior to the discovery of errors, and that was $30,500. Okay? All right. So we start with the unadjusted profit of $30,500 here. Okay? And based on the correction we have done for the first transaction, we know that we credited the repairs expense, which means our expenses are going down, and as a result of which the profit should go up. So we are adding the effect of the decrease in repairs expense, which is to increase the profit by 5,000. And the other effect on profit was for transaction number 3, where insurance expense had to be reduced by $90. And when insurance expense goes down, profit should go up. And therefore, we are adding $90 more to the unadjusted profit of $30,500. That's it. You can choose to show transactions 2 and 4 within these calculations, but you can just really write no effect if you do so, but it doesn't really matter. So as a result, the total amount is therefore $35,590, which is the adjusted correct profit for the year ended 31 December 2017. Okay? All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. Also, check the link in the description to book a free Zoom call and discuss your tutoring requirements, and I'll see you in the next lesson.